Welcome to the Gray Report. I'm your host, Spencer Gray. And if you're a multifamily investor, whether you're active, you're passive, you're in the right spot. There's been so much that's been going on in the multifamily industry that we're going to talk about on today's episode. So we're breaking into it, giving you actionable insights to make really well-informed investing decisions. So again, if you're on the investment side, or maybe you even work in the multifamily industry, property management, this is going to be an episode that you're not going to want to miss. Make sure you subscribe to the Gray Capital YouTube channel while you're at it so you can get updated when we release new episodes of the Gray Report or anything else multifamily related from Gray Capital. Investor Communications Manager Griffin Haddad is joining us once again, bringing it all home. Stick around. Let's get into it. Welcome back to the Gray Report. Once again, joined by Griffin Haddad, Investor Communications Manager here at Gray Capital. Griffin, look at all this. There's a lot that we have to talk about. I mean, the economy is uncertain. The multifamily industry is uncertain. Some deals are trading for sub 5 caps. Other deals are trading for, 6+ caps. If you talk to different buyers, they want to trade what they want to buy new stuff. They want to buy it for cheap. Mm-hmm. Sellers, they're saying, pound sand. It's hard to make sense of it.
Raises the question, does anybody really know what's going on?
I don't think one person does. I think as soon as you think you might know, you need to look at yourself in the mirror and really question this statement. I think the smartest people in the world don't really have a good sense of where we are and where we're going.
Which is why the Gray Report and all of these articles, research, opinions, put them all together, read what you choose to read, formulate your own opinion. But the best thing you can do for yourself in a time like this is just equip yourself with data, knowledge, opinions from folks that are claiming to know. That way you can be well equipped to move forward.
Yeah, got to synthesize it. And it's amazing how quickly the narrative changes. I think it's about every 3 weeks. Mm-hmm. And it's been like this for the last couple of years. But about every 3 weeks, we oscillate between going into a recession versus we're right in the sweet spot. This economy is going to keep just chugging along. And even though the entire economy has wondered whether we were going into a recession with employment in a potential scary picture, is AI taking jobs or seeing some job losses, but the unemployment rate is still slow. Inflation is higher than we want it to be, but it's not necessarily horrible. But then, then there's the, public companies like NVIDIA that are coming back and saying we've got some really strong earnings. Mm-hmm. And maybe that there is some real just solid growth that is going on. And maybe not everyone is being fired because of AI. Maybe it's efficiencies. Maybe it's just companies that are, being cautious and conservative after a period of overhiring. Mm-hmm. We don't know, but just as you said, it's aggregating all that information, putting it together, synthesizing it, and being up to date to allow us to make some good decisions. Because we all know that there are incredible opportunities whether it's a period of distress, it's a period of uncertainty. Because while a lot of investors, a lot of allocators will stay on the sidelines, that's when the best deals are had. Now, obviously, you don't want to catch a falling knife. You don't want to put yourself in a bad position. You want to be, risk averse, but you don't want to allow being risk averse to prevent you from seizing really good opportunities. One thing that we do here at Gray Capital to help ourselves, but also our investor partners, is we produce these research reports, aggregate information. We do our own data analysis. Hugh and our data analyst, John Chapman, did an incredible job on our latest research report. It's the Gray Capital Midwest Multifamily Forecast for 2026, where we're highlighting what is it? 6 markets throughout the Midwest, some of the top markets. I'm also analyzing some national figures to really just understand what next year is going to look like. Mm-hmm. And we weren't the absolute first, but one of the first outlets that started reporting that 2026 most likely we're going to see a below trend rent growth. Now in the Midwest, different from the nation, looks like we're going to see some positive rent growth, but still subdued from what people like to see. I mean, usually, again, you like to see rent growth in kind of the 3.5 range organically, because part of this whole business is, your revenue needs to be growing faster than your expenses. Like if you had to strip all, it's not just real estate, obviously, any business, but like what we're in the business of doing is we have a revenue stream that's going to go faster than our expenses are going to grow. And so as that spread between our revenue and our expenses widens over time, we've got more net operating income, we've got more cash flow, and that net operating income as it grows, you put a cap rate underneath it, and that translates to a much higher valuation. But if expenses are growing faster than revenue, well, you're screwed. You're moving in the opposite direction.
Right.
And so when inflation is potentially 3%, PPI came out this morning. It's about 2.7 year over year, which isn't too crazy. It's higher than what the Fed wants to see. But if your rent growth is only growing, for Columbus, we're looking at Columbus as an example. If rent growth is only growing at 2.2%, you got a negative spread there.
You do.
It's hard to make sense of it. Now, we're buying these apartments not for year one rent growth. We're buying great capital. We buy for mid to long term holds, 5 to 10 years, typically 7 to 10. And our belief is there's going to be some strong rent growth over the next 5 to 10 years, but it doesn't have to be in year one. But it's hard to underwrite a deal with low rent growth and high expenses, which is causing a lot of folks to go to the sidelines.
Right.
You want to take us through Columbus? Just maybe a quick overview, Griffin, of some of the highlights, some of the metrics that we're forecasting in the Columbus market for 2026.
Yeah, absolutely. Columbus probably is past the emerging market category. It feels like it's kind of surfaced maybe in the last 2 years for some more national attention, but it does have quite a bit of momentum continuing into 2026, really relative to the economic growth of the city and its suburban areas. For the longest time, maybe the last 2 to 5 years, Columbus has really been a story of supply relative to multifamily developments and units. But I think the leader of this story is really demand. As this economic growth of Columbus persists and continues, it's almost like they cannot build enough apartments in Columbus because there is still a large amount of absorption. The vacancy in Columbus in 2026 will be below, I believe, or if not right at the national trend, just a decline of 18 basis points from 2025. So you can see the demand is staying relatively steady as supply begins to kind of taper off in the back half of this year and into 2026. So relative to the national average, Columbus is still a leading force in multifamily fundamentals. And within the Midwest, it's one of the strongest rent growth markets that we're projecting moving into 26.
Yeah, our national average, just going back to the national average forecast, is 0.85%. And so that 2.2% that we're forecasting for Columbus is well above that national trend. And then, if you look at markets, we didn't forecast, we don't have forecasts for Sunbelt markets, but if you look at the CoStar forecast, most of them are forecasting negative rent growth. The one thing interesting about Columbus that I thought is that we're actually forecasting an increase in starts. Just based upon what our model is telling us, because there's so much demand. It looks like developers, again, from our forecast, are going to actually be starting to build, not necessarily going to be delivering, which is why it looks like they can achieve that 2.2% rent growth, but at least getting some new projects started to try to meet some of that demand. But it looks like it's going to be just much more balanced relative to where it was a couple of years ago.
Right.
All really interesting. If you want to learn more about other markets in the Midwest, if you haven't invested in the Midwest, or maybe you're a veteran, you just want to learn more, we are hosting a webinar for our forecast where we're going to go deep into each market and not only that, but kind of laying out our playbook, a Great Capitalist playbook for 2026. So the webinar's on December 16th. It's at 2 p.m. It's going to be a great webinar. You'll be able to come, ask your questions. And we'll be doing it on YouTube Live. We're going to be doing it somewhere else, right? Where else are we going to be doing it?
Right. I believe we're on Microsoft Teams.
Microsoft Teams is like an easier way. Yeah.
So Microsoft Teams live stream with John Chapman, data scientist at Gray Capital. We'll dive into the methodology. And then I think the most exciting aspect of the webinar is the opportunity to really get a better and deeper understanding of how this report and our market forecast are truly guiding the forward progress of our acquisitions and asset management strategies moving forward into 2026. So if you're thinking about investing in the multifamily asset class, if you are an investor in the multifamily asset class, and you're looking at the Midwest or are already allocated to the Midwest, join us and join John Chapman to decide or to discover how our forecasts are really guiding Gray Capital's operations.
Yeah, and it's not all rosies and pixie dust. We're not really pulling any punches. I mean, we could have put a report, only trying to find the positive, but markets that we're investing in saying, hey guys, rent growth isn't going to necessarily be that strong next year, but this is how we're tackling it. This is what we're doing it operationally, but also from an acquisitions perspective, why we actually think that low rent growth may provide some exciting acquisition opportunities. Why that is, you're going to have to hop on the webinar. So, go to graycapitalllc.com. You'll see a button. You can click right there. Be able to download the report, sign up for the webinar, and we'll see you there. Okay, continuing on. News flash across the board late last night, this morning. I got the email, and there's already been a couple articles written about it, but RealPage has reached a settlement with the U.S. Department of Justice regarding revenue management software. We've covered this story for quite some time here on the Gray Report. And I don't know if this is the final conclusion of this saga, but it looks like we're all the way there. I'm going to go over some of the findings, and just to bring you up to speed, this is all to do with RealPage's, and there are other companies that have similar products, their revenue management software. Opponents of this revenue management software were claiming that the software RealPage facilitated landlords to be able to collude to raise prices together, and therefore artificially raising all of the rent prices because they were basically, again, this is what the Biden administration and the Justice Department was alleging, is that it was allowing landlords to just collude into a cabal and say, hey, we're all going to raise prices together. If we all raise prices at the same time, renters can't do anything about it. The reality is quite different from that, however, because while RealPage has changed their product and how it operates, and it's not using nearly as much public or proprietary data, it's usually using more just the information that the property itself is providing to eliminate kind of any semblance of kind of collusion and price fixing. That did not stop the allegations in the lawsuits. And there have been several settlements of multi-millions of dollars of where property management companies had to pay out to plaintiffs who weren't necessarily admitting any guilt, but they just wanted the problem to go away. RealPage did not accept any payment settlement, but this is what they did agree to. So it says the settlement reflects RealPage's longstanding commitment to compliance and responsible innovation, rabble, ensuring our products continue to benefit both property owners and residents. Okay, so first is no findings or admissions of liability. The agreement includes no financial penalties, damages, or findings or admissions of wrongdoing. I will say that while that is true, they have changed how their software works. And they've never said that the way it was working was illegal or improper, but it was just trying to accomplish the same thing in a way that was very clearly on the right side of the law, which, in my opinion, it was always very clearly on the right side of the law. It was just public opinion was moving things one direction. Second bullet point, this is more for RealPage customers, is continuity for customers. There is no disruption to customer operations. All RealPage solutions remain fully available, compliant, and configurable to meet evolving legal requirements. I think they're saying like, hey, look, nothing's going to change your products right now. Don't give us a call.
Right.
But part of that also sounds like it's configurable to meet evolving legal requirements. So like, are you changing something? You have changed something, or what else are you going to be changing? Okay, the next bullet point is formalizing product modifications already made or planned. The settlement essentially commits RealPage to the modifications to its RealPage management solutions that it has been implementing since over a year ago. So they're saying that they didn't do anything wrong, but they are also saying like, well, we made changes to the way we were doing it, and we're going to continue to do it the way that we changed. Instead of, they could have said, we can now go back to what we were doing.
Right. They did make some changes. And then the last piece, which I find is really interesting, is independent oversight.
RealPage has agreed to an independent monitor to confirm the ongoing compliance of our revenue management products, reflecting our confidence in their integrity and our long-standing commitments to responsible operation and innovation. So they're going to have somebody watching over their back for a while.
Hired a full-time babysitter.
A full-time babysitter. So, I would say that. So what does this mean? What I think this means is at least that there's no longer a risk floating out there for property management companies who are using these revenue management products. Again, it's the same types of like pricing models that the airlines use, that grocery stores use, hotel rooms. So again, we've made this argument multiple times. I know housing, there are some special protections on, you can't discriminate. We obviously have fair housing, and housing can be treated a little bit differently. But what is so different about housing, as it is an essential for life. I don't think you have a right to a house. I'm more of like a negative rights versus positive rights type of person. But people like the idea of, hey, you need a house, so there are going to be special provisions. But food is also essential for life, and there's all kinds of pricing algorithms that allow commodity prices to be traded, and those aren't regulated, or it's not illegal to use an algorithm to find the market efficient price or where the market is on that. And then what we've talked about multiple times also is that if RealPage revenue management was driving up all the rents, why the hell have rents been negative for the last couple of years?
Right.
They're not doing very good. It's not doing a very good job. Like, where's the collude? Are we all colluding to lower rents?
Yeah.
And so that's so if the market is moving rents up, it'll suggest the rents should be higher. If the market is moving down, it's going to suggest rents are moving lower. We use a RealPage revenue management product called ARM, AIRM. It's an AI revenue management product. And it often finds opportunities to increase rents, but it will also tell us we need to lower rents. The only argument that can be made, I think, is that it makes the market a little bit more efficient. And so, in the past, a landlord may have only like adjusted their rent once a year. Like, okay, this year, 2026, our 2 bedrooms are going to be $1,500.
Right.
That's the price for the year. Set and forget it. Nice and easy. There's nothing wrong with that, except if all of your competitors move the rents to $1,600 or $1,650, you're leaving money on the table. All those leases you signed at $1,500.
Right.
And so this will basically tell you, hey, you might want to bump your rents up. Everyone's already increased the rents. And by the way, you're 98% occupied.
Yeah.
You're going to make, even if you move down to 95% occupancy, but you sign some leases at $1,600, you're going to be generating more revenue overall.
Right. And correct me if I'm wrong. It's purely a recommendation. It doesn't do it for you. It's not increasing the price. Still, as an operator, as a property manager, you have to get into your system, establish that price, negotiate with the tenant across the table as you're signing and executing the lease. It's not automatically updating your market rent without your consent.
Correct.
Yeah.
Correct. And it also, there's inputs of, what you're actually optimizing for. It could be you want to optimize for the highest rent in the market, or you can optimize for a certain occupancy percentage. Or you also might want to be optimizing for a rent roll or a lease expiration forecast that is more manageable. So, you want to spread those leases out. Or hey, I want to sign more short-term leases. You can it's all about incentivizing the types of leases you want prospective renters to sign, and it allows us to not lose as much on like days vacant. So someone comes in and they want to rent that 2-bedroom for that $1,500, let's say, but they want to move in a month. Well, a system like ARM or other revenue management products, they'll say that's fine, but it's actually going to be $1,510 if you want to move in a month. If you move in tomorrow, though, we can make it $1,490.
Yeah.
And so it takes in that, that vacancy loss into account. So it makes your whole operation much more efficient, less days on the market, because it takes into account that vacancy loss of like, yeah, okay, we can let this sit, but that's money that's burning a hole in our pocket that we're losing essentially.
Right.
So it's really interesting.
Just feels like in consideration of open markets and free enterprise, it seems like a tool that every sector of business should be implementing in order to drive bottom line and ultimately provide sound guidance to you as the owner operator of whatever asset, whatever business you're owning and operating, what your price point should be.
I think I agree. I think the only pushback is not from like a legal standpoint. It's a user experience. Does it improve your user experience by saying I can choose a quicker move-in date or a time for my lease to expire that gives me a better deal, and I like having that control?
Yeah.
Or is it confusing? And that's the negative feedback on like dynamic pricing, whether it is airlines or hotels or a house or whatever, or some like fast food restaurants talk about doing dynamic pricing also, or surge pricing. Is that it's like it can be frustrating to be like, what do you mean that this price may change in a week or two? Like, you've given me the quote. Why is it going to expire? Or like instead it just, why is the price changing? If I move in on this date, it's different.
So maybe just some more transparency up front to the consumer.
Yeah.
Our tenants.
Transparency and education. If someone's educated on like what this is, how to use it, how to take advantage of it, like how this is going to benefit you, not just benefit the landlord or the operator, people will be all about it. But it's when you are used to, what are your 2 bedrooms going for? $1,500. You're like, I just want the one price, and when I call you back in a month, sometimes we discourage like responsible, non-procrastinating people in the industry. If you want to rent an apartment like a couple months out, like it's not an option. Like, okay, we're gonna write your name down on a wait list. But like, it's like, no, your move-in date, if it's further out than a couple weeks, we may not even like show you that it's available. The availability only goes out so far.
Yeah.
And so, we don't really reward people that are planning ahead too much.
Right.
But the planners are.
Almost give a better deal to the folks that are in kind of somewhat of immediate, not panic mode, but
if you
need
are
a place to sleep tomorrow.
Yeah. If you are, nothing gets a property manager, leasing consultant, anybody more excited than like an immediate move in.
Yeah.
Immediate move. You want to move in today? Great. We got it.
Yep.
It's great. Okay. We got caps for the agencies. FHFA is announcing we got some of those caps. They're going up in a big way for Fannie Mae and Freddie Mac. Out of Washington, D.C., this came out on November 24th. U.S. Federal Housing announced today that the 2026 multifamily loan purchase caps for Fannie and Freddie, the enterprises, will be $88 billion each, for a combined total of $176 billion to support the multifamily market. This is good news because we need the lending capacity. It looks like this year we may be running right into the caps. So this increase is very healthy. And I can tell you just anecdotally, talking to a lot of lenders very recently, Fannie and Freddie, they're running into these caps. The FHFA basically limits them of like, you can't do any more conventional lending than what we're allotting you. And so when they get close to those caps, what they do is they just increase their pricing. And so their spreads will start blowing out. They're just not competitive on terms. And this is in a time period where we're supposed to be supporting housing. We're not trying to crash the economy by letting too many deals fail. But the agencies, they support housing by providing adequate liquidity to the market. They've been tightening things up recently because they're running into these caps. So hopefully we are going, not hopefully, the caps for 2026 are going to be up at again $176 billion between Fannie and Freddie, and that's a good thing. But man, these agencies, Fannie and Freddie, they need to be completely restructured. I mean, they don't deserve to exist in their current form, maybe with the current people that are there. Again, I do hundreds of millions of dollars with Fannie Mae and Freddie Mac of business because they've got this government guarantee, which makes their debt cheaper. They have essentially government mandated duopoly. I mean, they were basically created around the Great Depression to facilitate the securitization of home mortgages, and Fannie Mae became this big monopoly, and they created Freddie Mac. Was like, well, you need a little bit of competition, Fannie Mae. So they created Freddie Mac, and they're again most in the business of securitizing mortgages. And they do multifamily loans, and they make up about 50% of all multifamily loan originations. But it's a revolving door. The people that work there for months, maybe a couple of years, and they move on to whatever private sector gig. There's a lot of great people, I'm sure, working Fannie Mae, Freddie Mac. A lot of good people. It's just the way that they're being run today is really inefficient. And I don't know if they really should. We have a government guarantee that basically that backs these mortgages, that allows for a lower interest rate because it's more secure. You got the government's going to step in and say these loans aren't going to go bad. Does it help support housing? Yeah, on the margins. It also drives housing up, the cost of housing up, because all of a sudden I get better leverage. If I get more loan proceeds, if I get a lower interest rate, that allows me to spend more money on those apartments. I can pencil paying a higher price and get the same return. And multifamily is already nothing's without risk, but a relatively lower risk investment compared to, call it office, call it hospitality. There's tons of interest. If you remove the government guarantees, you'd still do plenty of business. There'd be plenty of support for housing. And I'm not necessarily arguing that the guarantees go away. Absolutely. I'm more just saying that I don't know if we need Fannie Mae and Freddie Mac in the form that they're in. So, and there's obviously a lot of talk about an IPO, privatization, all that. We'll see what happens. But again, we're in a period of where we have a housing crisis going on. Apparently, the federal, again, this is how maybe disingenuous the government is about fixing the housing crisis. We're talking about we're going to declare this housing crisis. We're talking about we talk about the 50-year mortgage and all this other BS. But it's well, the agencies are actually responsible for doing all the lending. They're not even playing ball. They're giving us tier 3 pricing on deals that should not have tier 3 pricing.
Right. We talked about how that's squashing deals. It's
squashing deals. Maybe is it on the margins? Maybe, but man, anecdotally, I've heard of multiple deals that have essentially been killed because it's the agencies didn't really, not just they weren't playing ball, they just didn't care because they're near their caps, these artificial caps.
Yeah, you start underwriting, certain pricing and expectations, and then all of a sudden they come back to you and they've tightened up their procedures, and now you're looking at pricing that no longer becomes appetizing to your deal, or definitely reduces the overall interest that maybe you have from your equity partners.
Well, in your, I don't know if we've talked about these exit tests, refinance tests, but it's like you're shooting in the dark. You don't even know what the target looks like, but they're saying you have to hit it. It's very clear when the requirements are the loan has to have a debt service coverage ratio of X, 125, 130, 120, whatever it might be. HUD could be down even as low as 115, 117.
Some of the upfront criteria, way more recognizable, understandable, identifiable. Yeah. But on the back end, that exit test, you don't even know what they're trying to solve for.
Comment below if you know what we're talking about. Comment below if you know. They changed the exit test. They don't tell you there's a model. And I've heard fables about this model and how long it takes to run through and check things off. We don't know what it's solving for. But the goal is to determine how risky is this mortgage? Will we be able to repay the loan at the end of the day? Then we don't know what the assumptions that they're using. And whether you can pass that exit test determines what your final loan will look like in terms of your loan proceeds, maybe even your spread, years of interest only, primarily loan proceeds. So you don't really know. And they also don't necessarily, they'll do it up front, but then they also do it, nearing close before they give you that final commitment. And if you don't pass the exit test or it's close, they'll shave off your loan proceeds without telling you necessarily why.
And as you approach close, we're talking 14 days, 21 days.
So we're not just making this story up. This is what happened on our last deal, Flats at Stones Crossing. Yeah, is we're getting ready to close less than 14 days. We were actually penciled to close within, I think, 5 business days. Yeah. And 5 business days. And they make a long story short, we get a word that like, hey, we're not fully passing the exit test. I'm like, what do you mean? Our DSCR is so high. We've got all this cash flow. Like they're like, well, we don't know any of the details of the actual exit test. However, they told us some of the assumptions. We don't know their model, but we bought a newer property, right? It's a 2024 construction. Had just completed a lease up, but it was fully occupied. They've been already burning off concessions, no longer even offering concessions at the property, highly occupied. But they said, well, a year ago you were offering concessions. Yeah, that wasn't even us. It was the property manager that was leasing the property out for the developer. And they were like, well, 6 months ago you were offering concessions. Yeah. 3% concessions. So we're going to assume you're going to continue to have 3% concessions throughout your entire hold period. Like, we're not going to operate the property like it's a lease-up property throughout the entire hold period. No flexibility, no wiggle room. But we're going to reduce your loan proceeds by $2 million.
$2 million. It came down to
5 business days before it closed. Hey, guys, we need you to bring another $2 million to the table.
Yeah.
I mean, this is a stabilized, super clean deal in an incredible submarket. Just solid deal. Like, so solid. And you've got these nice guys in Washington, D.C., and gals and people in Washington, D.C. that have some model that we have all we know is that they're using the 3% concessions aren't helping us. So again, am I a little bit bitter to the agencies because of that? It doesn't help. But there's been a lot of other instances of where, man, these institutions that basically have this duopoly on lending in our industry are not the quality institutions that we'd like them to be. And there should be some competition, but there can be no real competition if they've got this government guarantee and nobody else has the government guarantee. Mm-hmm. So
the only solution on that instance you mentioned is to go find $2 million in equity. You can't go put a secondary note on there because now you got to go back to the already committed capital. Yeah. Refresh them that now there's
the lender won't even allow you to do it.
Correct. Yeah. So the only way that deal gets across the finish line in the next 5 days is $2 million in common equity.
Fortunately, we've got a great team. Griffin and Blake were able to scratch that $2 million together. But
we did.
Fortunately, great capital. We have the capacity and the equity partners to be able to do that. That's why people award us deals. So our great capital always is able to raise the money, always closes on deals. But that's how you kill deals, guys. Okay, good news. First American, the title company, they put out a report. They do some research themselves, which I was impressed by. They are forecasting multifamily cap rates. They're poised to slip in 2026. Remember, cap rates going down means prices are going up. So if you're an owner of multifamily properties, cap rates slipping is a good thing. Mm-hmm. If you're trying to buy, things are getting more expensive. Might be tricky. That's why we said you really want to be buying now. Don't wait. Let's go right to this chart. Coming unstuck in time. I'm just going to read this. Bear with me. First American's multifamily potential cap rate model estimates that the market-supported potential based upon key fundamentals, including multifamily transaction volume, a measure of purchase demand, renter household formation, a measure of leasing demand, and multifamily debt flows, a measure of credit availability. When the multifamily PCR is below the actual multifamily cap rate, as is currently the case, it suggests that market fundamentals support lower cap rates than what we're observing. And then it says the chart below compares the actual multifamily cap rate over time to the multifamily PCR, which is their model. Both actual and potential cap rates rose in 2022 through 23 as the market adjusted to higher interest rates and repriced risk. It then leveled off. We've talked about doing this same kind of analysis, Griffin. We've steered away from it because some of the cap rate data can just be so god awful, and opaque and all over the place. I mean, I could point to cap rate studies today, and we were going over this when we were looking at the research report because we were thinking about maybe including some of that. I mean, ranges from 5 to 7%, or even 4.5 to 7%, depending on who you ask, which study you look at. They're using some tighter numbers that look a lot more familiar to me and more real when I'm actually talking to owners and brokers. Mm-hmm. But I don't know. This looks like good news for next year potentially.
Good news for next year. I think the most intriguing thing when I look at this chart, really from it's a 23-year span, it's the largest spread between actual cap rates and their multifamily potential cap rate. And so you would like to think that those two are going to, become married up, in the near future. It can't stay at that spread for too long of a duration. So either, like they're predicting, actual cap rates do need to compress or slip, and or their multifamily PCR is missing data or is interpreting the data maybe a little bit differently than it has in the past. So their prediction for it to come down and couple back up with its PCR makes a lot of sense.
I think part of it might just be the again, that uncertainty in the market and the lack of transaction volume, and the fundamentals that should drive pricing are pointing towards, okay, cap rates maybe should be a little bit lower, but that risk and uncertainty is causing buyers to demand higher returns, and they only will buy it if they are paying a lower price and a higher cap rate. I mean, I feel that if I want to buy something right now, even though like I could be bullish, I'm like, well, given the uncertainty, given the market conditions, given that we're not forecasting strong rent growth next year, you need to pay me I need to pay a lower price because I can't bet on a ton of growth. I can't bank on cap rate compression, even though maybe there's a projection, but what are projections really worth? They're not worth a whole lot. I have to trade on the fundamentals and the realities of today, which is, hey, slower growth. That means I need some cash flow. It means I need to pay a higher cap rate.
Yeah.
That's the mentality, but the fundamentals are telling a different story.
Right. This is exciting on the sell side, but on the buy side, it seems like really the last, let's just say 2 years, I've been hearing you, Jay, and everybody in the office talk about, that the bid-ask gap, or essentially what the seller is expecting for their asset. And then, similar to cap rate expansion, we've been asking for price discovery. On the buy side, obviously, we want to pay a better basis for the asset. And so moving forward, as we're predicting this article is predicting cap rate compression, cap rate slipping. How does this change our operational standpoint moving forward in regards to the acquisitions that you were talking about? Maybe not buying based on predictions, but buying on firm-rooted data and historical T12 rent rolls.
Yeah. I mean, it's core to our acquisition strategy right now, to be honest, because we have to use this kind of fog of war, this uncertainty, to make strategic acquisitions. And the only way we're allowed to do that is two things. One, we have a long-term hold, mindset and
patient
strategy.
Capital.
Patience. And we're also very bullish and convinced of the underlying fundamentals for housing over the next 10 years. A short-term strategy, we would not be able to kind of go in and execute. It's only by taking a long-term view of having a high degree of confidence that we're going to see rent growth over a 10-year period that's over expense inflation. And we're also going to see probably some cap rate compression at some point. And you want to put the least amount of weight on that cap rate compression. But it is a driver of, we think this is a good opportunity to pursue right now. And so it's letting the noise and the uncertainty and the low rent growth that we're projecting and others are projecting to get people to second guess themselves, to be hesitant. It sounds almost two-faced. We want our LPs to be confident, obviously, in us and in the market, but we want the rest of the market to be scared and uncertain and stay on the sidelines. Because in 2022 and other periods when there was just peak demand to buy and acquire, that's when it's so hard to find good deals. And even though you can underwrite high returns, it's the highest risk period because you almost have to overpay because you're relying to some degree on some sort of cap rate compression. And that we're just going to pop it off. We're not going to have to do anything. It's just a high growth environment. The market will take care of itself and it becomes a feeding frenzy. you can make a lot of mistakes. Versus there's not many buyers out there in the market that allows us to be much more competitive, get better terms on acquisitions. And the challenge is not getting too greedy and requiring like such a discount. Because everyone wants to buy like pennies on the dollar.
Right.
I'd rather buy 70 cents on the dollar, something at 70 cents on the dollar, a couple things at 70 cents on the dollar, maybe 60 cents, maybe even 80 cents, than wait to buy something for 40 cents on the dollar and not buy anything.
Yeah, potentially lose the deal by just trying to be greedy.
And it's not greedy in the bad way. You're looking for a great deal. You're looking to buy it at a discount, but you have to be realistic. Like there's a lot of capital chasing these multifamily deals. It's hard to decide where to put your money right now. You're not the only, even though a lot of people may be out on the sideline, like doesn't mean everyone's out on the sideline. Like there are still players that are playing the game. And so you have to know where the balance is of, all right, we're getting a good deal. We're getting it less than it would cost to build it.
Yeah.
But we're still competitive enough of where we can actually win the deal because there are still a couple buyers. So we want to move as many people over the sidelines as possible, but then still find where that sweet spot is to acquire at a price that we can actually, win the deal when it's possible.
Let's talk about the combination of 20% increase in the overall FHFA cap for lending, Fannie and Freddie. We've got, in the next article we'll talk about, maybe we can go there now, we've got increased transaction volumes in the back half of 2025 in regards to multifamily and really commercial real estate in general. How does that all transpire and communicate and talk to cap rate compression? And what does that all mean if you mix all three of those factors together? You got more liquidity, in the debt markets, compressing cap rates, and increased transaction volumes.
Yeah. Well, so transaction volumes have increased. I think they're up. So we'll move to this Newmark report. Transaction volumes are up 12.6% year over year. The debt markets, so there's going to be an increase in the caps for 2026. We did see a huge increase in debt originations in 2025 versus 2024. I think a 48% year over year increase for multifamily debt originations. But if looking at those two metrics, 12.6 versus 48 means that there's a lot more refinances that were taking place, which, again, within this Newmark report, not to go so far out of order, but we'll just do it real quick. One of the reasons I really like these Newmark reports are that they cover a couple areas of the market that not everyone else does. Specifically, some of these loan maturity reports and distress, and breaking it down in a really just kind of data focused way. So if you're a listener to the Great Report, we've talked about this a lot. There's $769 billion with a B in multifamily loans that are going to mature between 2025 and 2027. Obviously, we're in Q4 of 2025, and that's where the bulk of it is. We're getting past this kind of like peak, this like max Q, this max pressure environment where we've got all these loans that are maturing, and we can see here it's not multifamily. It's certainly not a loan, but multifamily has the most debt past original maturity still outstanding. Again, even though office may have seen more like fundamental distress, just no one was buying a bunch of office in 2022. Everyone was buying multifamily and a little bit of industrial, but it was a lot of multifamily. But we're past this environment. But so what that means is that 48% increase in debt origination, that was refinances. That was folks kicking the can down the road, bringing in additional equity via capital call, maybe some preferred equity in a lot of cases to, give that deal another shot at life. And some of those investments are written down. Some people just got capital returned, new investors swap spots with them.
Do these recaps, these refinances, does that data fall within the transaction volume data?
So a refinance would not. Okay. A recap usually would not also. Again, correct me in the comments.
Has to change hands?
Yeah, it typically has to really change hands. Typically in a recap, there can be like a swap out of the entity entirely, but a lot of times it's a swap out of the capital stack.
Okay.
It's essentially like a refinance, but it's the equity is replaced rather than the debt itself. And often the two will happen at the same time. There's a recap and a refinance occurring at the same time, but the same sponsor continues to own the same property. Now, again, I could be wrong, and perhaps some of those recaps are included in transactions, but I don't believe that they are. And again, a lot of them aren't necessarily might be recaps, but they might be bringing some preferred equity and just kind of stacking equity on top rather than just replacing the equity itself. And so we're going to be probably dealing with, there's going to be some zombie deals that are going to be hanging out over the next 5 years, because a lot of people are originating 5-year debt right now, especially with the agencies, because the 5-year treasury is kind of at the belly of the yield curve. You got like the 10-year treasury up here, then got some shorter term rates. The 5-year is kind of like right at the sweet spot. So there's going to be a lot of deals that are going to be hanging out for the next 5 years. And their hope is maybe we're going to get a little bit of value increase over the next 5 years. And maybe they'll be right. Just the challenge for those folks are, your return might be, there's going to be a lot of single digit returns, single digit IRRs for those folks. They're going to have another shot of getting that capital out, getting it back, not losing it. But you have to think about opportunity cost, because okay, you made 5% IRR. Good for you. Your money was tied up. You could take that money out today, drop it in. Like, let's say the stock market, I'm not saying it will, but let's say the stock market, it almost certainly won't. But if we have another year in the stock market like we did this year,
was it low teens return?
Yeah, you get low teens
12,
in
13.
a year.
Yeah.
So, or throw it into a new multifamily deal you're buying today, going to have a 5-year hold that's going to earn 15% from now till that hold period ends in 5 years, like flat, like the deals we're going to be doing. So is it a great use of capital to sit in those deals for another 5 years? Probably not.
Yeah.
Is it going to save face and the operator isn't going to lose money on the deal? Perhaps.
Yeah.
Perhaps. Let's just I'd like to go to some of these takeaways and start there. And we'll go through this relatively quickly, but again, if you don't have time to watch us to go through this report, you're like, I like to read these reports myself. I hear you. GrayCapitalLLC.com/newsletter. You'll get reports exactly like this and more sent to your inbox every week. It's the best multifamily newsletter. It's going to arm you with the most important research reports, new data, research, and opinions across the multifamily industry. We started doing this just for ourselves, for our own multifamily intelligence, for internal for the company. We said, man, there's no one else that's really doing this. This was, 5 years ago. We wanted to start disseminating it to our investors, our partners, and you can be among that coveted list by going to GrayCapitalLLC.com/newsletter. Okay, breaking into this report, we're talking about the spread of home ownership. It's widened. The big takeaway here that I thought was interesting, we always know it's more affordable to rent than buy right now. That's not new, but this new statistic, currently it is 2.7 times, the spread between the cost of home ownership and renting totaled $1,241, representing 2.7 times the long-term average of $457. This elevated spread highlights significant affordability challenges. I mean, it's 2.7 times more expensive to buy than it is to rent. I mean, that is stark. We've known that, but it underlines just that a lot of these folks that would have been home buyers are now renters. They're going to be renters for longer. And we talked about last week, the average age of a new first-time home buyer is like 40 something.
Yeah.
Oh my God, it used to be like 27 or 30. So people are renting for longer. Just more folks generally are renting than they are buying. This next bullet point I thought was important. This is about buying houses, but housing demand is housing demand. The University of Michigan buying conditions for houses data continues to hover near all-time lows, reflecting persistent consumer pessimism about home buying prospects. Again, we can talk about how no one wants to buy a home, but again, if no one wants to buy a home, that means not that many people are renting. Even though more people are forced to rent, they don't have an option to buy a home, they have to rent. No one wants to go and get a new place to live, is what that says. You know, in COVID, when it was so cheap to buy a home and rates were, 3%, we saw that incredible demand for sale houses directly translated to a ton of demand for rentals at the same time. It cuts both ways. No one wants to buy a house. No one wants to rent an apartment. That combined with, a ton of supply is causing this negative rent growth. Leasing market absorption totaled 42,000 units in Q3 of 2025, represent a normalization after an extended period of historically elevated absorption. We've talked about this for a while. As you know, we've built it, they came, and we've built less, and so there's still absorption. But as that new supply recedes, that higher level absorption is also receding. It's what one would expect. Rent growth did turn negative year over year in the third quarter of 2025. As we've mentioned, we've talked about that 48% year over year debt originations, the GSEs, which is the agencies Fannie and Freddie, still is about 50% of the market share. But bank participation has pulled back sharply, with market share down 50% since 2023. That's interesting. In contrast, debt funds, insurance companies, CMBS, CRE, CLO lenders have significantly increased their activity. And then investors continue to focus capital in the Southwest and Southeast and Southwest markets, which collectively captured 46.7% of total market activity. So again, folks are buying apartments, but still most of the transactions are taking place in the Sun Belt. And then kind of over on this pricing and returns section, talking about cap rates again. Let's go to the bottom here. Annualized total return for multifamily were 5.48%. Transaction cap rates, I'm going to the middle. Transaction cap rates rose 13 basis points quarter over quarter. So cap rates coming up, prices going down. Cap rates to 5.63%, while REIT implied yields edged down to 5.23%. Meanwhile, NCREIF cap rates fell more sharply to 4.94%. Again, these aren't all necessarily the exact same metrics, but I've seen deals trade for all of these cap rates. So, depending on the location, the quality, the type of deal, etc. Yeah, I mean, there are deals trading with a four handle, high four handle. People might say that's crazy. Now, everyone wants to trade for a six handle. Everyone wants to trade for a six cap. Some of the older vintage deals are trading at that level. Some kind of 5.75 to call it 6.5. Stuff that nobody wants to buy. Again, maybe 6.5, 6.25, but that's few and far between. If you got one of those deals, send it over to me. Okay, going through some of these charts, they do a really good job over at Newmark. This is just visualizing this spread between cost of home ownership and renting. And renting's been pretty flat over the last several years. And it's buying a home. These millennials just cannot buy a home. All right, purchase applications remain weak. So this is, again, the University of Michigan buying conditions for houses. Again, I know it's talking about buying houses, but if this doesn't help explain why rent growth turned negative so quickly, in addition to high supply, I don't know what else will. But people are just down, not excited to rent, and not to get too much into the weeds of the macroeconomy, but I don't know how much of it is AI. I think it's more of just, again, general uncertainty on the hiring side. Labor market hasn't been as strong because employers, are we going into a recession? Are we not going into a recession? I just hired a bunch of people this last year. I'm just going to not make any decisions. Let's wait and see. And so again, that means people aren't necessarily getting the raises that they want to get, and that all starts compounding. It's a self-fulfilling prophecy, potentially. Leasing market, we saw this demand, it peaked, and now it is starting to decline a little bit, as one would expect, as we're seeing supply decline all at the same time. This chart I really wanted to go over. This is seasonal leasing patterns shift in a post-COVID era. We've absolutely experienced this ourselves anecdotally. Typically, we'd see most of the demand, the peak leasing season, kind of May, June, July, starting in March. This year, it like kickstarted in February and really like peaked March and April were like peak leasing season. And by July, it was like lights off. Like we were done.
And that's exactly what that shows, right?
And that's
there.
exactly what that shows. And we also have seen some like weird surges in Q4. Like we've signed some leases, this last month. Where in August, maybe we weren't signing as much, or back a little bit earlier.
So the thesis is then COVID pandemic influence on the distribution of lease execution starts, terminations across the 12-month calendar just kind of became a little bit more evenly dispersed.
Yeah, I think we became slightly decoupled from the school calendar of where everyone was trying to get an apartment rented before school started. I think everyone was working from home, doing school from home, and it kind of like didn't matter as much.
Right.
And so everyone's schedule that year got thrown off. That means leases, were just signed at more random times throughout the year. It just continued. And so, once you sign a bunch of leases, instead of signing them in June or July, you sign a bunch of random leases in February or March. That's when, if you're signing 12-month leases, that's when they're going to expire next year. And so you're on that cycle, and you have to proactively, if that's not the cadence that you want for your leases to expire, you have to proactively, sign, instead of 12-month leases, you're signing 10-month leases or 14 or 16 or 18-month leases.
Just culturally as well, just trying to figure out the influence on this chart and what has really, it's a fairly drastic improved distribution of leases across the 12 months. Lifestyle changes in regards to work from home and maybe the higher demand or the increased implementation of different lease durations or lease terms, 6, 12, 18 months, maybe 6 months becoming more popular as, tenants become a little bit more nomadic or fluid in where they choose to live. Do you think that has any implications or influence over this chart? Is maybe operators and property managers are not just offering a 12-month lease over and over again, but now they're offering 6 and 18-month leases?
I mean, it's a really good idea. I mean, I think the the impact, we talked about dynamic pricing earlier. I think the impact of dynamic pricing, where you're maybe choosing like a 10-month or an 18-month lease versus a 12-month lease, is definitely impacting the market in ways that I don't think we've really fully caught on to. I haven't really honestly seen too many studies of the overall impact of dynamic pricing, not just on like what it does to increase rents, but renting behavior and impacts of seasonality. And again, you might be an operator may use it or may choose to use it either to concentrate their leases in the leasing season. A lot of operators intentionally want to get all of their leases, to expire in the spring. River Club was an example. I mean, like all the leases expired in May. It was like every single one. It was like we had 70 leases expire in 1 month. Yeah. And then, in November and December, we had 0, which you can understand someone being like, I don't want to have any leases coming up in December because, like, who wants to rent an apartment in December? And if I am going to rent it, that's usually when demand is the weakest, so I'm going to rent it at a lower price. I'd rather rent when the prices are the highest, which typically is in the spring. The challenge is you have to sign a lot of leases in the spring to be able to accomplish that and achieve that. Yeah. I think the dynamic pricing has impacted operations in some unintentional ways. And it's not necessarily bad. I mean, this is really a smoothing of the lease expiration.
Smoothing, good word.
Because instead of these peaks in Q2 and Q3 and then the negative in Q4, it's just kind of more moderate throughout. And obviously this year we're going to have some negative rent growth earlier on than even this chart would express. Now, Griffin, I know earlier today we were working on our monthly investor reports. We're going to be sending out to investors here before we get into Thanksgiving. This rung true, and I asked you when you sat in here. I'm like, does this look familiar?
Yeah, it sure does.
Its renewals are proving especially accretive, is the title of this chart, and it essentially is describing that a lot of the effective rent growth isn't necessarily coming from new leases, and in fact, we're seeing the royal we, as in like the whole multifamily industry and Great Capital's portfolio, we're seeing more rent growth on our renewals when people are choosing to stay rather than on signing new leases. It's much harder to come by a new lease than it is to get someone to decide to stay. And we've talked about it, about how, again, people are uncertain. They don't want to move around. And this is directly expressed in this metric. It doesn't usually look like this. I mean, again, there's been instances of where it's gone negative for just a quick minute. But really, it's very, actually, no, this is really kind of the first time. Well, sorry, no, in 16 through 20, this is marking, where renewals were a little bit more expensive. I don't really remember during that period that renewals were typically more expensive than market rent growth. Maybe on a national level, renewals typically were something that you did kind of nominally of like, hey, $25 more, a month.
Yeah.
It wasn't something necessarily you pushed. But when kind of the rent increases in COVID happened, all of a sudden it created these huge spreads between kind of in place and in market asking rents. Could have been hundreds of dollars. And so then you started saying, hey, well, we need to get some of these renewals closer to market. Maybe you're not going to bring them all the way up to market, but we got to get them closer to market. Yeah. And there's still a little bit of that going on of like, okay, we got some of these renewals that may be now $300 below what we're asking on the market, but our market, which is like $300 more than what we were charging, we might need to bring that down to call it $250. So there may still be like a nominal gap, like the effect of what you're charging between new leases and renewals, but that gap is shrinking, and the renewals are getting closer to where the new leases are, especially as the new leases are being brought down. That doesn't necessarily, now you can potentially be charging more for renewal than your new lease, but that's called an inverted rent roll, and your existing tenants don't usually like it when they're like, wait, you're asking me to renew at $1,560, but a guy off the street, you're asking him to pay $1,500.
Yeah.
I'm just going to cancel my lease and walk in on the street.
Just sign a new one. Yeah.
Exactly. It's like trying to pull a quick one on me. So it can be a challenge. Interesting chart here. Looking at all kinds of different credit spreads and bonds. Newmark's making the call very clearly. They're saying markets are not pricing a recession. They didn't want to describe any other way. Yields and spreads have generally narrowed since Liberation Day. They're not calling for a recession. And if you had to put a gun to my head right now, I'm not calling for one either, to be honest. I think we've got a bumpy road, but I don't think there's going to be a recession.
Lucky for you, I do not have a gun today.
Well, that makes one of us.
That's awesome.
No, again, if you're looking at buying multifamily in Indianapolis, Columbus, and the Midwest, there will be a recession next year, but I don't think there's going to be a recession. There could be, but I don't know. I think we should just keep buying apartments.
Right, I agree.
Smartly. You need to buy the apartments to when, if there is a recession, you're protected for your downside, which means you buy at a price that you're comfortable with, that can sustain zero or negative rent growth for multiple years.
Right.
You either have reserves in the bank or you've got a really good spread. You always have to buy these things assuming there's a recession the next year. If you have that mentality, you can continue to buy, and you're going to buy smartly. You're not going to absolutely royally screw up. If you buy as in like everything is going to hit the sweet spot,
right,
and you're going to just rip it on rent growth and cap rates are going to compress, you're going to overpay for something. You're going to make a mistake. But again, just how I started in this industry was we're going to have a recession next year, because it was like post GFC, and it all seemed like it was just still such a house of cards.
Yeah.
And in a large way, the economy still is. It just, I don't know, the house of the cards, we've gotten the super glue to get the cards to stick together. And we're willing this economy to just continue to just crank along. There's obviously some other things going on. We've talked about debt originations. We talked about GSEs. We talked about loan maturities. Anything else in this report, Griffin, that stood out to you? Again, just getting back to potential multifamily distress concentrated in bank CLO and debt fund lending. I I don't know. We just went through the whole multifamily market. We went through what's going on today, what's going on, going to happen in 2026, what's happening in Columbus, what's happening in RealPage. What are your, in Griffin, you're putting together the newsletters every week, so
Right.
you're just downloading this information straight into your brain.
I think I liked the word that you used earlier was the oscillation of back and forth between, maybe not bull or bear market, maybe not, an enthusiasm or a lack thereof, but it does seem like we're oscillating in this period of time. And there's people that are fearful of which direction the markets may go. And I do think that as we look at being buyers of multifamily assets, you've said this since I've been in the building, that there's really not a better time to buy than right now. And we look at the fundamentals in all of the multifamily markets. We did our 2026 forecast. In the Midwest specifically, the fundamentals remain very strong. It makes us largely excited and very bullish on the future for multifamily housing, specifically market rate multifamily housing. There's a connotation in the syndication space, and just learning this from talking to investors. There are operators out there that have gotten into deals that are not performing, underperforming, and or are giving keys back to banks, having the LPs take over for the GP. I think that from putting together all of these research and reports on the newsletter, the Midwest right now, and looking forward, remains the best risk-adjusted return in regards to multifamily investing. And I think that if you want to do it, you need to pair up with somebody that is as deep in the data as we are. It doesn't need to be gray capital. We would obviously love for it to be gray capital. But just taking a look at how we operate, how we use this data, it does have me quite excited for the Midwest and the markets that we operate in relative to how they're trending comparative to the nation. And so I keep finding that over and over and over again in our articles. And there's sometimes they're just barely briefly mentioned of, hey, the Northeast and the Midwest continue to outpace national trends. Very rarely do they come through in a graph, or there's the headline, maybe not, posterizing the Midwest, but somewhere in that article, there'll be a mention of how the Midwest continues to outpace in regards to multifamily fundamentals moving forward and just kind of historically.
Yeah. I've heard some rumors of some institutions heading to the Midwest, potential big deal.
Right.
Can't name any names, but big institutional deal for a lot of indie property, a lot of Midwestern deals. But I'd like to say, I think you made a good point, is you need to find a group. If you're in the market looking to invest in multifamily, what's going to work over the next 5 years. There could be some incredible buying opportunities in the Sun Belt if you can buy low enough where you don't need any rent growth over the next couple of years. There's still going to be supply that's coming online. But we are very lucky where we are. We happen to be born in the Midwest, so we're experts of Indianapolis and other markets.
Yeah.
And lucky that when I decided should we invest outside of Indiana, because when I'm learning everything I could learn, talking to everyone I could speak to, a lot of the big players were all saying you need to go to the Sun Belt. That's where all the growth is. You need to go to those smile states because that's where the population growth is. And, Indianapolis and the Midwest, we had some decent cash flow and the rent growth was okay. And the population growth was like slightly positive, but just like slightly positive.
Mm-hmm.
Very thankful that we decided, hey, look, there might be higher growth in the Sun Belt, but I'm never going to know those markets like I know Indy and other markets in the Midwest. Mm-hmm. And I need to take advantage of those inefficiencies in the market to exploit what others don't know. So I can go to Fannie Mae and Freddie Mac, get the same type of debt essentially. I'm going to buy at a higher cap rate. I'm going to generate higher cash flow. Mm-hmm. And if you're buying for cash flow, which I think the best way to buy and invest into real estate, especially multifamily, it seems like a great opportunity. And then what's happened over time is, that just doing what we know, not necessarily because it was at the time, I think it was the absolute best market of like, I'm gonna look at every market in the country, but this is just where I am. This is what I know. And it's not a bad market. And we now are finding ourselves in maybe some of the best markets in the country right now, certainly the best region. And, I think we've done a really good job, the 10 years we've been in business. I like to think we're a really good operator, and we've made some really good investment like choices. But I also know that it's partially just where we are. And I know of a lot of competitors that I think that, were more aggressive than we were and have done things that I wouldn't have necessarily have done.
Mm-hmm.
But they're all in the ones that are in the Midwest that were doing that are still kind of okay. And there's a lot of groups in the Midwest that do exactly what we do that have absolutely crushed it along with Great Capital over the last couple of years.
Yeah.
So do I think Great Capital is special and we do a great job? Obviously I do. But I'm also just being real with everybody that we've been in this incredible region.
Yeah.
And it's just getting started. The acceleration is just beginning. Jobs, affordability, we're still not building nearly enough housing. And do you want to go in without really having the full knowledge of that market, or investing with someone who is entering the Midwest, entering Indianapolis, entering Columbus for the first time, or do you want to allocate with a group that we've turned over every stone?
Right.
We know every vendor, we know every broker, we know every property.
Mm-hmm.
We've seen it trade 3 times or 4 times. We've underwritten it 3 or 4 times.
Yeah. Now on the maybe we're wrapping up, but institutions coming into the markets in the Midwest, as a current owner, get you quite excited as an opportunity to maybe roll up a portfolio sale, or cap rate compression as institutions come into the market. As a buyer in the market, can sometimes be maybe not intimidating, but the increased competition. Maybe they've got more inexpensive capital. How do you it's kind of a double-edged sword, that bifurcation in the thought process. But as an owner operator and somebody that's also looking for future acquisitions, when institutions come to the market, what does that do to your mental? How do you process that?
Well, you set it up pretty accurately. It's really good for the existing portfolio, for all of our investors that we've already partnered with us on existing deals. It makes buying new deals more of a challenge. Now, typically those institutions have a specific buy box, and so part of it is, how do you navigate around that buy box? Whether that's buying maybe a smaller unit count deal that maybe they're not looking for. Maybe they're only, I like kind of 250 unit deals, but maybe they'll only, if they'll only do 250 or above, maybe we'll go after a 200 unit deal.
Right.
With our centralized management, if we can make the efficiencies work on a 150 unit deal, which there can be some bad economies of scale with a 150 unit deal or less. But if we can make the operations work and the big institution doesn't want to play there, it could be an opportunity. Also, going a little more tertiary. So while they come to like Indy, for example, maybe we pop to Fort Wayne. And we're looking at Fort Wayne a little bit more intensely. And, we cash in and sell to Blackstone or whoever, our existing portfolio.
Right.
Or parts of our existing portfolio in Indianapolis, while we pick up deals in Fort Wayne, in South Bend, in Bloomington, and some of these growing markets. Go a little bit more suburban that Blackstone hasn't fully underwritten yet. They don't have a white paper on
Got it.
Pendleton or whatever. And we're like,
Sure.
okay, it's outside of Hamilton County, but we know the dynamics. We know the path of progress. Or like a Lebanon, or just some of those other markets that might not fully be on their radar just yet. So you got to be dynamic, but also, it's are they going to be in the market for 1 year? Are they going to be in the market for the next decade? And if they're in the market for the next decade, you're going to probably see some gradual cap rate compression over that time, because once whether KKR or Blackstone or whoever jumps into the market, typically they flock. The birds of a feather flock together, and so you're going to see some other similar groups or quasi institutions follow their lead, because they're basically going to be copycatting what they do.
Sure.
So, but that doesn't all happen in the same year.
Right. No, I think that's great. I mean, a lot of the strength of Great Capital and our local presence here is to be able to identify these emerging markets, or these secondary and tertiary markets, and even more so the assets within those markets that have maybe been undervalued.
Yeah.
Or have some growth potential.
Exactly.
Cool.
Well, thanks for watching this episode, Griffin. Thanks for putting together the newsletter, being here again today. Make sure you hop on to the Great Capital website, greatcapitalllc.com. You get access to our multifamily forecast report. But also sign up for the newsletter while you're there, and we will see you not only on the next episode, but on the webinar for the 2026 Midwest Multifamily Forecast on December 16th at 2 p.m. Eastern, joined by myself, John Chapman. It's going to be an incredible conversation. Again, not just going over just our findings, but also, again, some of the strategies that we'll be implementing in 2026 to buy cash flowing multifamily properties in these Midwestern markets. Anything else, Griffin?
Happy Thanksgiving.
Happy Thanksgiving. All right. See you next week.